Hello friends, welcome to CEC Live Lectures. Dear friends, today we are going to talk on ethical issues in financial management, and for the discussion on the topic we have with us in our studios Dr. Namita Rajput. Dear friends, Dr. Namita Rajput is a principal in Sri Aurobindo Evening College, University of Delhi. Dr. Rajput is a prolific professor and an author of numerous books. Friends, if you wish to ask questions from Dr. Namita Rajput on today's topic, then do call us through our toll-free number. Our number is 1800110430. I repeat, our number is 1800110430. You are just requested to call in the last 10 minutes of the lecture only, and kindly ask questions related to the topic too. Now, I would like to welcome our guest, Dr. Namita Rajput, once again. Hello, ma'am. Welcome to the session.
Good morning, friends. The topic of today is ethical issues in financial management. As you all know, that accounting is the language of business. So there are so many ethical dilemmas, so many ethical issues which are very important to understand as a student, so that when you actually enter the realities, you are able to cope up with these kind of problems. The corporate accounting and finance, which refers to the accounting practices and the reporting through the financial statements of public limited companies, is broadly categorized as follows. Number 1, financial accounting. Number 2, financial management. Now, the financial accounting is the language of business. It is basically meant to measure and translate and sum up the impact of all business transactions into the financial terms in form of the statements. Now, such statements, they take the form of balance sheets, income statements, cash flow statements, and it facilitates an organization to analyze and evaluate. So, as we know that the business is exhibited through the financial statements, and there are a lot of financial statements, as we have, namely the balance sheet, the income statements, the cash flow accounts, the income and expenditure account, if we are talking about the non-profit organizations. So basically we formulate these kind of financial statements, and they are the window through which the overall exhibition of the company is taken place, and we analyze these statements and evaluate these statements to come on to the results, that is the financial analysis and the financial results. So they are so important to make. And basically when you talk about the balance sheet and income and statement account, it is periodical. Whether it is business is profitable and worth pursuing based on its financial input alone, the enterprise formulates its business strategies for financing its revenue, cost economies, and overall efficiency and the shareholders' wealth. The process of accounting can thus be summed up as a systematic recording and reporting. Now, as and when the financial statements take place, as and when the financial transactions are happening, they are recorded for the business purpose. The recording is done not in a very rough format. We have a particular format for it. It is recorded chronologically, that is as and when they occur, the date wise. We record them with certain rules and regulations. We make the reporting in a very financial, in a good way, so that it is very easy for others to understand it. And basically whether we are moving in a profitable direction or not is overall exhibited through its financial statements only. Now, what is the overall efficiency of the shareholders' wealth? Everybody would be interested in understanding that whatever amount you have invested in the business, whether you are having profits or you are moving towards the losses. So it is through the financial statements analysis that we are able to have this kind of analysis that yes, we are profitable and we are not. And definitely we follow a proper process, owing to which we make a systematic record and reporting of the financial transactions, and therefore we move on to the further records. Now, the analysis of the financial transactions of any kind of a business is most important thing. Now, archaeologists have also found the evidence that the practice of accounting is as old as civilization. Now, as a matter of fact, the history of accounting has been traced back to the history of writing. The success of the business in the earlier Italian, Renaissance is created to the double entry bookkeeping forms during the Industrial Revolution. Now, what is a bookkeeping? That every debit has its own credit, and we record it on the both sides, that is the liability and the assets of the organization. Now, basically, when you keep the accurate records of the business by accounting, their registration and the regular transactions is there. This provided by them is a means by which they are determined profitably of the business. We can broadly classify the process of accounting into two sub-branches. 1, financial accounting, and 2, the management accounting. The financial accounting is defined as a reporting of the financial position and the performance of a firm through the financial statements issued to the external users on a very periodic basis. Not only this, the financial statements, as stated earlier, typically includes the balance sheet, the profit and loss account, the cash flow statements, and definitely they are all followed by the supporting documents. These documents are published by all the listed public limited companies and are required to be audited by the external auditors for their accuracy and integrity. So now we are talking about the financial accounting, which is basically the reporting of whatever is the financial position of a company and the performance of the overall financial statements is concerned. The financial statements, as stated earlier, it typically includes the balance sheet, the profit and loss account, and overall the cash flow statements. Now, these statements are very important to understand because they exhibit the financial position of any kind of a company. And not only the recording part, as and when they occur, definitely we record them, we analyze them. And not only this, there is a proper auditing of the accounts also, so that we are able to have and present the accuracy and the integrity of the accounts. The main characteristics of the financial accounting are as follows. 1. The financial statements are meant primarily for the external users like investors, shareholders, and analysts. The financial statements must be prepared in accordance with the generally acceptable accounting principles. We call it as GAAP. Now, as we all know, that financial accounting is most important part of the business because it is the language of the business. We have to be very particular in adhering to the rules and the regulations, and we follow certain predefined rules, that is the generally acceptable accounting principles, and we apply to all the transactions which take place, and we show them in the financial statements. And they are basically for the investors, for the shareholders, for the analysts, etc. Not only this, the financial accounting data is provided, it must be accurate and timely. That is, we divide the accounting period basically into the small periods, and basically we call it as a financial year, which starts from 1st of April and ends on 31st of March. Since we understand that the life of the business is perpetual in nature, that is continuous in nature, so you don't know what kind of or the number of years the business would move on. So for the sake of simplicity, we divide the accounting period basically in the financial year, and whatever we do it annually, so that we are able to trace the performance of the business, the profits of the business, the expenses of the business, and the overall analysis of the business. So this is most important thing for any kind of an individual to understand, that yes, the financial accounting is most important part of the business because it gives us, number one, the accurate data, the timely data, which is divided into the the small annual periods, and of course these statements, they portray the company's past performance as well. For example, I want to compare the financial statements of how the company was performing in last 5 years and how the company is performing this particular year. So just by making a particular line diagram or maybe a bar diagram, you will be able to analyze, yes, the company is towards the profit path or it is declining. So these kind of analysis is most important for any business to do it, because these important things are very important for the business because they give us a track, they give us a particular path, and they give us a particular picture of the business that yes, whether we are moving on a right direction or not. These statements, they provide a picture of the business as a whole. So overall, the financial accounting gives us a holistic view of what business is all about, what expenses are occurred, whether the expenses are going up or down, whether the revenue is going up or down, and what is the scenario in relation to assets and liabilities of the organization, what is the scenario as far as the gross profit and the net profits of the business is concerned. Because these things are the landmark important points owing to which we strategize the business. And not only this, the financial statements, they stand by themselves and they are definitely most important records for the business to analyze and move further as far as the business strategies is concerned. Now we have discussed the first part, that is the financial accounting. Now we would be moving on to the management accounting. Now what management accounting is all about? It is the process of identifying, measuring, analyzing, interpreting and communicating the information for the pursuit of an organizational goals. The management accounting is also known as cost accounting because we do a postmortem of whatever expenses has been done in the organization. The management accounting involves the budgeting, the forecasting, the analysis, the cost behavior, the cost management, financial controls, the decision making ratio analysis and so on. So all these things are most important to understand that the management accounting is all about, doing a complete analysis as far as the cost accounting analysis is concerned. Now, basically the management accounting is definitely, we do a lot of deep analysis of what the budget was. We call it as budgeting. What budgeting forecasting is, like for example, the expenses, if you have a look on the past records of the business, they are moving on. So that means for the current year, we might need more expenses. So the budgeting would show more of expenses and would also analyze the cost behavior, owing to which we will have to analyze as far as the cost policies of the company is concerned, followed by, because it has a direct spillover onto the profits also. So we make the profit, the overall profit analysis also, that what would the company behave, perform as far as the finances is concerned. If the cost is moving up, how we are going to control the finances, how we are going to reduce the expenses, how we are going to increase the revenue. So we do a lot of analysis, and these analyses are a part and parcel of the management accounting, and they give us a very deep, important, vital, pertinent information which is a base for making the overall policies for the organization. Now coming on to the main characteristics of the management accounting. Now we understand the basic characteristics of the management accounting. The first is as follows: the data which is involved in the process are meant solely for the use, the understanding and the analysis of the internal users. Whereas if we look upon the financial accounting, which we have already taken care of, it is basically for the external users. But as far as the cost part is concerned, the analysis is concerned, the budgeting is concerned, it is most important for the internal users only. Now coming on to the preparation of the reports under the process of not subject to regulations or GAAP standards. Now, as we told in the beginning, you were told in the beginning that whatever accounts we make, we are not doing it on our own. We have to prepare the rules, the regulations, and we are predefined whatever are the chronological recording of the accounts, they are as per the generally accepted accounting principles. So these are the standards, and we have to adhere to the standards because we cannot go hayway as far as the preparation of the management accounting and the financial accounting is concerned. Now the relevance and the flexibility of the data are completely determined by the users of the data. The use of the management accounting techniques, if we look into the future profitability and the decision based on existing data. The management accounting draws heavily on finance, economics, and the quantitative methods for the decision making and analysis. The key difference between the managerial and the financial accounting is all about the managerial accounting information is aimed at helping the managers within the organization to make the important decisions. In contrast, the financial accounting is aimed at providing the information to the parties outside the organization. Now, when you talk about the financial management, it encompasses the two core processes of resource management and the finance operations. The resource management is efficient and effective deployment of an organization resources when they are needed. Such resources may include the financial resources, inventory, human skills, production resources, and the information technology. The financial operations involve the execution of joint finance mission to provide financial advice and guidance. The support of the procurement process, providing pay support and providing disbursing support. Broadly speaking, the financial management includes the following: 1. Financial analysis and planning. 2. Investment decisions. 3. Financing and capital structure decisions. And number 4. Management of the financial resources. So they are a part and parcel of the financial management, and it is a very encompassing activity because all the important and pertinent decisions relating to the financial management are taken care of in this. Like we do all sorts of financial planning and analysis in this. What kind of money has to be invested where, that is the investment decisions are also part of the financial management. The investment decisions are very important to analyze because there are again certain set rules and regulations which will help us in knowing whether plan A is better or plan B is better as far as the investment decisions is concerned, because there are some methods which are called as like the payback ratio, then we have the internal rate of return, or we compare the expenses and we compare the returns of the future. We have certain discounting techniques. So we apply them together to come on to the important decision making. Now, not only this, the overall capital structure, that is what are the short term, what are the long term decisions, the capital structure overall, what is the debt, what is the equity, etc., are also a part and parcel of the financial management decisions. Now, overall, how do we manage the financial resources is also a part of the financial management. Now, when you take such important decisions, then the role of a finance manager becomes more pertinent and more important. The finance manager basically heads the finance department. The finance manager has evolved, and today he or she wears many hats depending upon the task at hand. Financial manager's role involves the following activities: providing and interpreting the financial information, business modeling and forecasting, monitoring performance and efficiency, analyzing change, risk assessment, and strategic planning. So overall, if you understand the role of the financial manager, it is so important to understand that if any of this role is not taken care of, the whole finances will be in trouble. So we take care as a finance manager about how much money we would be needing in the future, how much money we are spending in the current years, from where the finances will come. Definitely, we also analyze what is the cheaper sources of finance owing to which we will satisfy our future needs. We monitor the performance and efficiency of the various sources which are involved, we analyze the risk assessment techniques also, and we do the strategic planning also. That yes, this is the scenario, this is the budgeting, this is the cost analysis, and overall we analyze the various perspective, paradigms and the frontiers of the various sources of finance which is available for a company, and then we would come on to the strategic planning. The role of the financial manager or finance manager is not exhaustive at all. It is having so many roles to play. We have listed few, so let me list 4 more. Formulating the long-term business plan is a very important function of a finance manager. That is, from where the money is going to come in, because we have certain long-term planning in our view, planning in our domain. So from where the money is going to peep in, what are the sources which are available to fulfill the business plans for the future. So we formulate the long-term business plans accordingly. Secondly, we do the pricing competitor analysis. This is also very important. There is a product in the market and you have so many competitors which are there. So they must be having some cost structure behind it. So we try and compare the competitors' analysis policies as far as the pricing structure is concerned of your own company and of your competitor also, so that we are able to have a holistic view whether your pricing policy is correct or not. Then we have to develop the complex financial, the models. To develop these complex financial models, we need so much of basic information for this, and overall we are able to analyze onto the financial models which are available for them. Then we analyze the financial implications of new and the future ventures. Now see, when you are a part and parcel of the company, there are so many small plans which are there under your domain, that which plan you have to follow. The plans are there for making your current views, what are the the financial ventures which are available, which the company wants to pursue, whether they want to have some kind of a joint venture, or maybe they want to have certain kind of a partnership between the co-ventures are concerned, or maybe some kind of a collaboration is there. So financial collaborations are there, or maybe want to have certain export paradigms review for the future. So all these things they are done by the financial manager, because it is always depending upon the correct information which you would be needing to churn at one frame, and then you are able to analyze and come on to the financial final decisions. Not only this, then finally you have to prepare the accounts relating to it. Preparing the accounts is again done through GAAP, that is the generally accepted accounting principles. You have to do certain kind of budgetary control, in which you have certain prerequisites in mind, that this is what the company scenario would be as far as the finances are concerned, as far as the expenditure is concerned, and then you will be able to analyze that yes, the expenses are more or the finances would be less. So you are able to have a budgetary control, which is most important angle, which is seen by the financial manager. Now of course, the liaising with the other team members, for example, across the organization is also very important for the person to understand. Why so? Because everything you have to have money, be it purchase department, be it accounting department, be it say research and development. So there are so many subsections of any organization. Everything and anything in the organization takes care of only one parameter, that is money. Without money, nothing is possible. So financial manager makes this possible by strategizing every small thing they have, every minute thing they have, as far as the licensing is concerned, as far as the controlling is concerned, preparation of the accounting is concerned, then developing the financial models for the organization is concerned, and so on and so forth. So in this particular role, the managers, the gatekeepers, agents, promoters of the organizations, these individuals are responsible to the shareholders of the organization. According to the Companies Act, the management is the agent for the owners of the firm. The shareholders or the owners of the business provide compensation incentives to the management, which has accepted to work in their shareholders' best interest. Shareholder wealth maximization is the main goal for most of the companies. Since incentives of the managers are tied up in with the profitability of the business, there is a scope for the managers to evolve in fraudulent activities to maximize their payments. Such malfeasance drains the corporate resources, causing millions of dollars worth of losses to the shareholders and basically to the investors. So let me give you a recap of whatever we have done today in this part of the lecture. We started with the ethical issues which are there for the financial management, and basically the corporate accounting and the finance takes care of two parts, financial and the financial reporting and the financial management. And overall the financial accounting is the language of the business, and the overall transactions are summed up according to the generally accepted principles. And as a matter of fact, that is basically for the external users. And when you talk about the management accounting, it is basically the data which is involved in the process of meant solely for the use, understanding and analysis of the internal users also. The relevance and the flexibility of the data are completely determined by the use of the data, and whatever important techniques we use like budgeting, overall controlling of the finances, the sources of the finance, the investment decisions, they are a part and parcel of the financial management. And basically this is for the efficient deployment of the organization resources which they need if you want to have the more efficiency, the best financial analysis, the best financial decisions is concerned. So overall the role of the finance manager was discussed, which is very important and pertinent to accept. And with these words, I hope you're able to understand the important things as far as the ethical issues of the financial management is concerned. Thank you so much.
With this note, thank you, ma'am. Thank you so much for giving us this productive session. Friends, you're requested to be with us as we are back after a short break, and we are going to discuss more and more. So keep watching us. Thank you. Hello friends, welcome back to this session. Friends, as you know that our today's topic of discussion is ethical issues in financial management. In the previous session, we discussed on the basic issues. Now we are going to talk on ethical issues. And for the discussion on the topic, we have with us in our studios Dr. Namita Rajput. Dr. Namita Rajput is a prolific professor and currently she is principal in Sri Aurobindo College, University of Delhi. Friends, if you have any question in mind, then do talk to us through our toll-free number. Our number is 1-8 0010430. Now, I would like to welcome our guest, Dr. Namita Rajput, once again. Hello, ma'am. Welcome back.
In this part of my lecture, I will be talking on the ethical issues in finance. The Professor John Boatwright of the Business Ethics and the Management School of the Loyola University, Chicago, talks about how the theories of ethics in finance can be developed around the three broad themes. 1. In financial markets. 2. In financial service industries, including banking and insurance. Number 3. By the financial people in the organizations. Now, what are the proper ethical issues in the financial market? So, we'll take up one by one. Professor Boatwright mentions the level playing field established in the financial markets, a set of rules and the code of conduct which sets up the expectations in which the market dynamics work. However, the playing field is often influenced and moved in one way or the other based on the information dissemination and resources. On 11 September 2008, the Supreme Court upheld the ruling of the Securities Appellate Tribunal judgment that refused to set aside the penalty imposed by Security Exchange Board of India on Rajiv B. Gandhi, his wife and sister for insider trading, in violation of Regulation 3 and 4 of the Security and Exchange Board of India Insider Trading Regulations 1992, read with the Section 15G of the Act. SEBI, while holding the Gandhi, his wife Sandhya Gandhi and sister Amishi Gandhi, the guilty of insider trading in the script of Walker on the basis of unpublished price-sensitive information, and the same was not available to the investors in general. And it was definitely the contention of the SEBI that Gandhi, the Walkhart's company secretary and CFO, has access to the information regarding to the financial position of the company. Being aware of the fact that the company's results for December 1998, the quarter reflected its negative performance over the previous quarter, and knowing well that the sharp prices would crash once the results were published, Gandhi sold their shares on 21 and 22nd January before the board meeting took place and the market could react to the company's financial results. It was also reported that his sister and wife had also purchased the shares of the company when the price had fallen after the board meeting. In the broad sense, the financial resources would include the services rendered by all the financial institutions that are engaged in some form of borrowing and lending. In this wide sense, it would include the financial intermediaries such as commercial banks, hire purchase finance commission, finance companies, insurance companies, pension funds and investment trusts. But if you say, in our analysis of the fraud committed in the financial services sector, we will concentrate on the commercial banks and the insurance industry because of their overriding importance in the Indian economy as large providers of finance to the different sectors of the economy. The legal authorities define the fraud as a crime that involves the use of the dishonest or the deceitful conduct in order to obtain some unjust advantages or someone else. This definition of fraud implies that the fraudster commits a crime through deception using the dishonest means with an intention to cheat others, persons or institutions to make them a part with something of their own. So basically, the frauds in the banks, the insider trading, they are very important part and parcel of the overall ethical issues in finance. Now, as far as the fraud in the banks are concerned, it is assumed that the fraudsters known as that his or her act is false or is without belief in its truth, and knowing it, he or she induces the others to act upon the matter, which will definitely deprive them from the possessions. These frauds are seen in the various segments of industry such as the financial services, that is fraud in credit cards, checks and other types of identity relaxed services, etc. The insurance sector, that is the internal fraud committed by employees against the insurer, fraud by policymakers and the claim fraud and the fraud committed by the intermediaries such as independent brokers and the agents, there are other types of frauds such as those relating to telecommunications, securities and the computer. Hence, we will deal with first two in the financial sector. Available statistics, it shows that the losses incurred by the banks due to the frauds are far larger than the losses arising out of robbery, dacoity, burglary and the theft all put together. The use of the high-tech instruments such as the computer has increased the quality and the extent of fraud to the enormous degree. A study of bank frauds brings to definitely the light several types of frauds with or without the overall connivance of the bank employees. Not only this, the authority on the subject identifies for about the elements responsible for the commission of the bank frauds. The following are the frauds in the banks. 1. Active involvement of the staff, both the supervisory and the clerical. Now, either the independent of external elements or in connivance with them is number 1. Number 2, failure on the part of the bank staff to follow the scrupulous and the instructions and the guidelines laid down by the regulators like the Reserve Bank of India. 3. The external elements basically perpetrating the frauds on the banks by the forgeries or the manipulations of the checks, drafts and other negotiable instruments. The collusion among the businessmen, the top bank executives, the civil servants, the politicians in power to flout the rules and the regulations and definitely to throw the banking norms to the winds. Now, unauthorized extensions of the credit facilities such as cash credit, pledging the hypothecation of goods against the bills or book debts, pledging of spurious goods, hypothecating goods to more than one bank, inflating the value of goods, removing the goods with the connivance of the bank employees, pledging of goods belonging to the third party, accepting the obsolete and inadequate stocks are all done with a view to cheating the banks for its illegal gratifications. Apart from the frauds committed by the outsiders on the banks or their own clients, banks themselves resort to unethical practices against the guidelines provided by Reserve Bank of India. For instance, the National Consumer Dispute Redressal Commission at New Delhi has recently issued a notice to the Reserve Bank of India and other 88 commercial banks, including the foreign banks operating in the country, for delaying the crediting of the checks. This was based on a complaint that the bank in the country are alleged earning nearly INR 6210 million in interest every day due to delays in crediting the checks sent for the clearance. Now, according to a complaint, a gross violation of the rights of the millions of the consumer was taking place in the banking industry. And it was definitely pointed out that there was a huge time gap between when the check of the bank customer was paid by the drawee bank and when the bank actually credited the customer's account, and still the further time gap if we consider when fraud was made available for the withdrawal. The complainant said that in the financial year 2005 and 6, nearly 1300 million checks were cleared by 88 banks operating in India through their balances across the country amounting to about INR 113.4 million. Even if it is assumed that the bank enjoyed the benefit of fund flout only on 50% of the checks deposited, the daily rate of interest would come to about 6210 INR million a day at 4% rate of interest. It was submitted that as per the RBI guidelines, a local check was to be credited on the third working day from the date of acceptance of checks of the counters. Even if it is assumed that the bank enjoyed the benefits of fund float only on 50% of the checks deposited, the daily rate of interest would come to about 6210 INR million a day at 4% rate of interest. It was submitted that as per the RBI guidelines, a local check was to be credited on the third working day from the date of acceptance of the checks at the counters, that an outstation check drawn on a bank in any of the 4 metropolitan cities was to be credited within 7 days. And of course, this procedure was not being followed. Now we would be coming on to the type of the bank frauds. It was contended that such a delay was not permissible under the RBI guidelines, as well as the Bankers Code framed by the Banking Code and Standard Boards of India from time to time. The frauds in deposit accounts are opening to bogus accounts, 4 signatures of intruders, the collecting through such accounts stolen, or the 4 checks or the bank drafts. The frauds are also committed in the area of granting the overdraft facility in the current account of the consumers. The large number of frauds has been and is being committed through bank draft, mail transfers and telegraph transfers. Now basically in the recent times, several bank frauds have come to the light in the credit card and also in the extension of the home loans. The same property is pledged to more than one bank by using the original look-alike mother documents, which made possible by the color photocopies. For instance, in the Chennai bank, fraudster was arrested in September 2006 on the charges of cheating 22 nationalized banks during 2000-2004 of 15 million INR by pledging just one immovable property as collateral at INR 4 millions. Now basically acting on a complaint from a nationalized bank, the City Crime Branch, that is the CCB, police found that he had taken the loans ranging between INR 5 million to INR 1.2 million. Phishing is a tactic of using an email to solicit the sensitive information from the users. It is a recent form of cyber attack in which the attackers make internet users divulge the sensitive information about their bank accounts and the personal details. Now some internet, the weaknesses in the web browsers and the internet make users susceptible to these kind of phishing attacks. The fraudsters, they use the emails to persuade the user to be a part of this sensitive information, like the password for the websites, the password for the financial information, etc. In a typical attack, a user receives an email message from the attacker with the address and the logo or image of the bank or the financial institution, making him or her believe that the message has come from these institutions, and the fraudsters, they try to convince the users to part with the personal information and uses them for the wrongful purposes. So this is definitely a part and parcel of the ethical issue. For instance, the user receives a mail regarding the bank account verification. Generally, the entire email message, which is sent to an image pointing to a phishing URL, the moment you click, your password will be hacked, your information will be hacked. And when the user clicks the hyperlink provided in the email, it opens a genuine bank website in the background with the pop-up window in the foreground asking for the bank account details. So this is how they smartly open the account so that the customer is able to believe that this email has come is a genuine email. And definitely there have also been instances where the scammers, the attackers, they embed a web link into the email message. The actual bank site, but it connects to the phisher's website. When an exact replica of the bank site is created to a fraudulent extract the personal information from the user. The solution to this problem lies in the training and end users not to reveal any kind of sensitive information. Now, how to avoid the phishing, scams and attack is a problematic thing, because every now and then you are surrounded by such attacks. So how do we avoid these is a most important question to be answered. To avoid the phishing scams, the end users need to be suspicious of the emails, especially when they call for an urgent request for the personal information about one's own financials. So if you get an information like this, you should be very suspicious whether it is coming from a right source or not. That why would bank require your quick and a current and a urgent information is a question to be thought about. So you should never be prey to that, and you should always think twice before sharing your personal information or clicking on any kind of a URL which is provided in that particular email. Now better still, they should not react to such emails. The users, they also should be very careful to verify the sender's credentials before they enter into any transaction on the basis of the message they receive by the email. One should avoid the links in these suspicious looking emails to open the websites. It should be ensured that secure and updated website is used while submitting the sensitive financial information, including the details of the credit card for the online purchases. It would be safe if one checks one's bank statements to check for authenticity of the transaction. Now, what are the measures against the bank frauds? Prevention of Money Laundering Act 2002. For a long time, especially after the adoption of the licensing policy, restrictive imports, import substitution, rationing of the foreign exchange and severely punitive Foreign Exchange Regulation Act, that is the FERA, there was a large degree of smuggling and money laundering in the country. Half-hearted attempts by the government at the different times, they did not yield any tangible result in curbing this menace, and this caused huge losses to the exchequer. Prevention of the Money Laundering Act 2002 is a comprehensive legislation to curb the evil of the money laundering. Reporting of cash and suspicious transactions. Section 12 of the Prevention of Money Laundering Act, that is PMLA, they cast certain obligations on the banking companies with regard to the preservation and reporting of the customer account information. Under the Act of PMLA, each bank has to furnish the information of transactions to the Director of the Financial Intelligence Unit to India, FIUIND, within the prescribed time, where the principal officer has the reasons to believe that the transaction or a series of transactions are internally and integrally connected so as to defeat the provisions of a particular section. The information should not contain the nature of transactions, the amount of the transactions, the currency in which it was demonetized, denominated, and the date on which the transaction was conducted and the parties to the transactions. And for this purpose, the banks shall have to maintain a register containing the information in the following types of transactions. Number 1, all cash transactions of the value of more than 1 million INR or its equivalents in the foreign currency, all series of cash transactions integral its equivalents in the foreign currency connected to each other which have been valued below INR million or its equivalents in the foreign currency where such series of transactions have taken place within a month. And definitely the aggregate value of such transactions should exceed INR 1 million. All cash transactions where forged or counterfeit currency notes or the bank notes have been used as a genuine, and where any forgery of a valuable security has taken place. All suspicious transactions, whether or not are made in cash. Now, what are the measures against the bank frauds? The type of reports and their periodicity. The following types of the main reports are to be prepared by the branches. The first is the cash transaction report, that is the CTR, the counterfeit currency report, that is the CCR, the suspicious transaction report, that is the STR. All these reports should be submitted by the branches to the crime office, which shall be retransmitted by the circle offices to head offices along with the comments, observations of the circle heads. The cash transaction reports shall be submitted on a fortnightly basis by the branches to the circle offices, and of course, for the first fortnight ending the 15th of the month, the report shall be sent before 20th, and for the second fortnight, the report is to be sent before 5th of next month. While preparing the CTRs, the individual transactions below 50,000 INR may not be included. The suspicious the transaction report, that is the STR, definitely should be furnished by the the branches and the circle offices on a daily basis, where any transactions, whether cash or non-cash, or the series of transactions integrally connected, are of any kind of a suspicious nature. Now, the branch manager should record his or her reason in the register for treating any transactions or a series of transactions as suspicious. The counterfeit currency report shall be submitted as and when any transactions relating to the deposit of the counterfeit currency notes or defrauding the bank by fraud, high value securities, etc. takes place. Now is the time for the reporting to the RBI, that is the Reserve Bank of India. The primary responsibility of the reporting transactions as per the guidelines of RBI lies with the principal office of the bank. Now, basically, overall, when you see about the transactions which takes place in the ethical perspective, they are most important to be taken care of, because there are so many problems as far as the nationalized banks or the ethical issues with the other private banks are concerned. So, you have to be very particular about the underlying mission which is behind the measures of the fraud. So, basically, when you talk about the measures against the bank frauds, the principal officer is the ultimate authority to decide on the reporting of the transactions to the FIUIND. Now, coming on to the compliance to the anti-money laundering standards. The RBI has directed that monitoring of the transactions of the bank has to be strictly done as per the anti-money laundering standards prescribed. The banking scheme of 2006. The RBI has introduced the Banking Ombudsman Scheme 2006 with the objective of addressing and resolving the complaints relating to the bank services. The Indian Bank has been phenomenal changes during the 20th century, starting with the banking being concentrated in the hands of the few selected group of the business communities. Like overall, when you talk about the Chettiars in the south, Marwaris in the east, Gujaratis in the west, and the banking industry has moved from limited area of operations to the global operations through the process of the social control, nationalization of banks, and the greater autonomy to the banks. Now, there are certain constraints to the ethical practices as far as the Indian nationalized banks are concerned. Over the last 3 decades, we have transferred the quite some distance from micromanagement of the banks by capping the call money rates, stipulating the banks by capping all money rates, stipulating the interest rates across the board and the public humiliation of the banks. The personnel who recited and resisted the direct lending in the report of non-banking proposals. Now, as far as in the several sectors of the Indian economy like oil, gas, telecommunications, metal and banking, public sector units compete with the private sector. The competition is becoming increasingly acute in case of the banking, mainly due to the greater speed and the degree of implementation of the financial sector reforms 1 and 2 of the Narsimham Committee compared to the slow pace of the reforms of the other sectors. In respect of the nationalized banks, including the State Bank of India and its associates, who manage more than 70% of the total banking transactions and the banking business, the government has to play a dual role. One, as a major shareholder of the respective banks, and two, as the ultimate regulator and upholder of the public interest, leading to the overall inherent conflict of the interest. And as the owner, the government is very much interested in ongoing profitable growth of the business banks by deploying the available resources based on the general demand at the market determined cost. As the upholder of the public interest, the government needs to, basically make concessional credits to the selected priority sectors to ensure the continuous employment and productivity in the less developed areas. The dichotomy is the best exemplary and exemplified when the government is directing the public sector banks to grant the agricultural loans at the concessional rates, that is from 7 to 9%, which amount may not be even able to cover the basic cost of the resource mobilization. At the same time, the government decisions to the bank to sanction the 40% of the total advances to the priority sector continues. And not only this, one of the basic principles of the corporate democracy is no shareholder enjoys a specific right vis-a-vis the other shareholders. In fact, while listing the new equity, the stock exchanges endeavor to ensure that even the private equity entities that typically have a special rights relating to the appointment of the management personnel, maintenance of healthy financial the parameters and buyback provisions, etc. Now, recent such rights, such being able to the case, the recent government directions on the interest rates to the public sector banks, especially enunciating from its role as a majority shareholder prima facie at the variance with the commercial judgment of the bank's management and circumventing the interest rate signals and emanating from the bank regulators, they have to be seen in this light. Several private sector banks have senior management personnel who have migrated from the national banks. So the government expects the public sector bank to compete effectively and efficiently with the private sector banks without providing the former a level playing ground, resulting into enjoying the special advantage like the tenure of CEO, remuneration, accountability of the CEO, etc. So these are the points which have to be kept in mind as far as, because they are the constraints to the ethical practices in the Indian nationalized bank. So an elaborate examples have been given in this regard. I hope you've understood these ethical practices. Thank you so much.
With this note, thank you so much for giving us this session. Friends, you're requested to write to us at info.cec@nic.in if you have any query or if you wish to give your feedback. We are going to meet again soon. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.